Well, I'll get us started. Our second session is going to focus us on the advantages of investing in real estate. So our panelists include Ron Dickinson, who's sitting immediately to my left. Ron is the founder of Dickinson Investments, and there's information about what Ron does in your swag bag as well, so if you want to read up on Ron. Ron's been a great partner to Metonic, and he's brought along a lot of his clients into our real estate deals, so he's got a pretty good handle on what he looks for when it comes to investing in multifamily real estate and its importance. We also have Adam Kirshenbaum. He's our Chief Operating Officer at Metonic. Many of you in the room know Adam, and he's the one that really got the whole thing started when we started syndicating deals. He also knows a lot about 1031s, and he's going to touch on some tax implications there. So I'm going to throw the first question out to Ron. Metonic believes that real estate's essential for any investment portfolio, and I think you do as well.
Sure.
But if you would, can you tell us how you believe real estate fits into the ideal investment portfolio?
Yeah, so first I'll start off with just a little bit of a story. Where Aaron maybe represents family office, large clients, we say we represent the small guys. So we may have somebody with a $2 million, $5 million portfolio, but if you're going to allocate a portion of your portfolio to real estate, maybe 20%, which would be high versus other advisors, that's $400,000 to $1 million that's going into real estate. Then if you want to diversify across new properties, old properties, different cities, you might be looking at 5 to 10 properties. It doesn't leave a lot for any one deal for that investor to put in. So for the most part, my clients didn't have access to Metonic. And actually the first representative I met from Metonic came over to visit with me, and Bob may not want to hear this, but I was talking to John, and he goes, well, at the end of the meeting, he goes, we're kind of used to guys writing checks for $2 million, to our deals. And I go, well, that kind of leaves me out, or my clients out, because we need 100, 200,000 at a pop across 10 deals. And then I said, well, I look at your website, and I don't see what properties I can invest in. He goes, well, we call you. And I just thought, well, that was the end of the meeting with Metonic, and he left. But fortunately, a few weeks later, he called back, and I think Bob came over, and they go, we have a small deal that you might be interested in doing. It's in the Bluffs, and it's $5 million, and you're going to take $2 million of equity. And if you could put a group of guys together to come do that, you might be interested. So we then took 10 guys, toured the property, we bought it, put the $2 million down. But the nice thing was, either we caught it right or et cetera, but $2 million down on $5 million property, 4 years later it appraised at $7.9 million. So that's a $2.9 million profit on your $2 million investment. So it worked very nicely. So that's what we've been seeing with Metonic, delivering deals like that to us. That's probably been our best one, but there's been some tremendous returns. So we've been very appreciative of that. And everything they've told us that would happen on deals has happened. So our confidence is growing quite a bit. So we bring groups of clients together so they can have access to investments like this. And they're difficult to buy in your 401ks or IRAs, or you shouldn't. So it really takes your personal portfolio. But I want to, most of my clients, when I started talking, I've had a heavy interest in real estate since my college days. I was trying to flip houses back then, not very successfully, but I started young, and I always liked real estate, and I wanted to invest more in, but this was out of reach. We started putting clients together. Most of the clients had a little bit of pushback. They go, well, you talk about it not being liquid. I can't, I'm used to pushing a button and selling an Apple computer and getting my money tomorrow if I want it, and you're saying it's not liquid. Why would I do that? So I had to kind of develop this slide to demonstrate to them why we would have interest. So there's like 3 attributes you can have with any investment. You can have good returns, you can have low risk or less volatility, or you can have liquidity. And you kind of have to pick your poison. You can have 2 or 3, but you can't have all 3 in any one investment. So stocks can give you terrific returns at times, but they might be volatile. But they're liquid, you can get your money back quick. Bonds don't return so well, and they're even worse here in the last 5 years. But they give you a nice, safe environment. And so during COVID, when everything was down and somebody come in and said, I need money now, it gave me a place to get money from. But smooth ride and liquid. Private real estate comes in, the returns have been double-digit returns, and very smooth ride. You don't get a statement every month that says, hey, you dropped 35% during COVID. The value stayed the same because your cash flows were the same, but they're not liquid. So a lot of clients were pushing back on that, and I So I talked to the guy, I said, well, you have $2 million, you're retiring next month, how much money you need out of that next month? And he just stares at me blankly and he goes, well, I don't need any of it. I'm going to live on the income. I said, so you are telling me liquidity is not your first concern. If I can give you 3 to 5 to 10% more money by having a portion of your portfolio not be liquid, would you be interested? So that started the conversation with clients, and they've developed grow into it, and so it's, they like it very much with it. So we have this slide here to kind of show the advantages. If you mix all three of those together, and each person you mix them differently depending on their financial plan, their need for cash, and their tolerance for risk, you can really have the best of all worlds by mixing those three things. So I love stocks. I don't like the volatility with them. I'm not a big fan of bonds myself, but some of my clients need bonds in there for liquidity purposes. And we love real estate. So I shot a video a few years ago. We did a little podcast, and I said, you know, the traditional retiree has 60% stocks, 40% bonds. That's been the way of doing it. And you can take 4% withdrawal rates, et cetera. I said, I'm just not a fan. I can't see myself, I'm projecting myself at retirement. I can't see myself buying bonds. And then I just blurted out, I said, but I probably would buy 60% stocks, 40% real estate. And that started a trend, because even on the big seminars I go to, I listen to the big players like Blackstone and et cetera, and I say, how much does Harvard Endowment put into real estate? And they'll go, oh, 10%. And they say, so you're telling me we have steady cash flows, we have terrific returns, and you're only allocating 10%? Why would you do that? Why wouldn't you put more in? So we have been very progressive in that front for years of adding a private component. Now, private brings that non-volatility because it's not valued by the emotions of the stock market. It's valued based on cash flows. So it's a pretty simple concept. We do private equity, we do private credit, but private real estate's probably our more favorite way. So not priced on the emotions of the market, steady cash flows, capital gains, and tax advantages is why we would build that into portfolios. You do have to be very careful about liquidity, though. You can get too much of your money tied up, so you always have to know when you need money. You need to do projections forward. But the returns have been very nicely to make up for that. So we're going anywhere from 20 to 40% in our portfolios, which is probably more progressive in private deals. And we're coming into groups of people with that.
So I'm going to stick with you, Ron. And
okay.
Besides being an investment advisor, Ron's also a CPA. So maybe spend a little bit of time talking about some of the tax advantages of investing in real estate.
Yeah. First, let me go to the next slide real quick. I noticed that might be a little bit hard to read, but there's 4 lines on there, and it just illustrates a little more. The high line with the top one is stocks. And I just pulled this from one of our funds that we can invest in. So you have accredited investors. You have to have a net worth of $1 million to have access to a Botanic type deal, private deals. Non-accredited investors, if they want to get involved, you can actually go into a mutual fund type environment. It's not a publicly traded REIT with high volatility, but it's private. And so this is just one of the funds. I just randomly pulled it. And it's only for illustration, just to illustrate a concept. But the stocks over that period when that fund started has been about 15%, so terrific returns, but you'll see some very large declines in there, especially during COVID period. The very bottom line is bonds. Very nice. I can sleep at night. The returns have been about 3%. Kind of difficult to meet your long-term goals at times if you're making only 3%, but there's still a component why we need that. But those 2 middle lines is what I want to show clients to help them understand why you would do this. Pretty decent returns. In this case, it was 8.6%. I will say our Botanic deals have been double digits, but for this case, it just shows. And that real jagged one in the middle, that's publicly traded REITs. So REITs are real estate in corporations that trade on the stock market. The problem is they still have the emotions of the stock. So COVID comes, REITs drop like a rock. So you still have that emotional element. And what happens when things drop is people make bad behavior choices. They sell out, or they do something that maybe isn't good for their long-term interest. So volatility has a negative impact unless you have the ability to stick with it. Well, that nice orange line in the middle, that's privately traded real estate in this particular fund. And it's a steady ride like bonds, but gets you stock-like returns. So that's just a picture's worth 1,000 words to say why we would do this. And then so we like that. And then I've also been thinking a lot about inflation lately, because we know as rates have come down, like my one apartment building we bought, where it doubled the equity, and that was like a 4-year period, it just went up that quick. What happens when that turns around the other direction? And fortunately, real estate has performed very well in rising interest rates. And even though as rates come up, that might push the property value down based on that static cash flow, renters are typically have a job that's getting cost of living increases. They can afford more rent, and rents are being pushed up. And we're starting to see, I think in Omaha market, 4% rent increases, across the nation 5 to 8, and I think you were saying even higher than that at times. That influences your cash flow. Cash flow determines your value. And so the apartments and especially multifamily out of all commercial real estate has done very, very well during rising interest rates, or at least holds its own. So anyway, back to your taxes.
Yeah.
So, jump in.
Yeah, I'm just going to jump in real quick. I don't know if this mic was working. Anyway, just wanted to point out, we really appreciate Ron's view on real estate investing, and it always makes me laugh when he says, the small guys that have $2 to $5 million worth of net worth and are investing hundreds of thousands of dollars in deals, and may we all be small guys someday. But anyway, I think there is a bit of a misconception out there that, investing in large real estate projects really for people who are writing really, really large checks and for, kind of the super wealthy. And a lot of people think the only way they can really invest in real estate would maybe be to, buy single family rental homes or smaller 2 and 4plex type properties. And we really tried to create a platform here that allows people to invest in real substantial and, real estate transactions without feeling like they need to invest a substantial portion of their net worth in order to do it. The other thing I just point out as far as advantages of multifamily in today's market, we were just at a conference fairly recently, a private wealth conference in Denver, and all the talk right now is inflation, and everybody's very concerned about kind of a coming inflationary period. And multifamily provides a really good hedge against that multifamily inflation. When you think about other types of asset classes, like an office building, for example, you might sign a 10-year lease, 5-year lease, 10-year lease that has a fixed rental rate, and sometimes you'll have some escalators in there, but sometimes it's just a fixed rental rate for a period of 10 years. And you think about an inflationary period, the value of that rental stream gets hit pretty hard as inflation comes up. The nice thing about multifamily is you have short-term leases, typically a year or less, so you can kind of ride that inflation wave and continue to increase rents throughout that period. And we're also able still today to put really, really good interest rates, even though we probably are going to see some rise in interest rates, but we're able to lock those in for a really long period of time right now, which provides a lot of safety against that inflationary period. So I think you're going to continue to see people looking at multifamily over the next 18 months, regardless of kind of where we land on that.
Yep. So one reason we like real estate, I say you can make money in 4 ways from it. You get a positive cash flow if you get a quality deal in the right location, and that's where Metonics helped us a lot, is you get a positive cash flow from it. And I just personally look for 6 to 8%, but there's times that's double digits. You're getting a capital gain on the building as it goes up slowly over time. You're paying your mortgage down, and then there's tax advantages. And the tax advantages, to try to keep it at a very high level, they're extremely favorable for real estate. And it's, when you think about it, intuitively, it's a little hard to understand. You get to write the building off. And equipment, it comes from a concept like equipment. So if you're a manufacturer, you buy a piece of equipment, that equipment goes down in value over time. So the IRS says, hey, you got to deduct it over 5-7 years. That's to replicate the decrease in value, to recognize that. So you get a deduction for it, but it's a real loss you're having. Well, the building, it's strange because the building's going up in value, but you still get a deduction for depreciating the building. And I think the real estate industry just had a good lobby. And so what's happening is we're pulling these cash off the properties, but our K1s are showing negatives on it. And as a CPA, I used to say, why would I invest in something that's losing money and you're just giving my own money back? But no, it's going up in value. I was a little naive back in the early days with that. But it's you're pocketing cash. We're not paying taxes on it currently. Now, it's not forever. You do pay taxes on it someday. We call that depreciation recapture in the end. But you might be 5-10 years you're putting cash in your pocket. And if you're not paying taxes on it, it allows us to put it into another deal. So in the one property, we doubled our money. There's times we made 30, 40, 50%. They're able to refinance and pull cash out, but our K1s are showing negative. And so that helps you grow your net worth very rapidly when you're able to do that. Now there is a day you pay the piper, and there are some ways maybe out of that. But at the end, if you sell and put the sell price in, you're paying tax on that sell price plus that previous cash that you put in your pocket. So It could be heavier at the end, so you've got to look for ways to get out of that. And so 1031, very technical concept of trading properties, is one way to do it. Another way is to buy more properties that create more depreciation to offset the gain there. Or in my case, I'm trying to accumulate, I'm in about 12 deals so far through Metonic. I'm trying to buy as many as I can, create a cash flow machine when I retire, so that cash is coming off. I don't plan on ever selling the properties, unless you guys say it's just time to sell and we need to. So I'm going to hold them my whole lifetime. I get to write the building off, so I'm writing the principal of all my investment off as well. So if I buy Apple Computer, I don't get to deduct the cost of it, I just, the gain. But I get to deduct my cost, shelters the cash flows, never sell it, keep pocketing this retirement income, and then when I die, I give it to my kids, boom, it all goes away. That's called step up in basis. That's a little bit in jeopardy at the moment, but that's one of the advantages, yeah. So that's why the tax advantages are just outrageously positive for real estate. It's the one industry that has that.
Thanks, Ron. Adam, let's spend a few minutes talking about 1031 exemption. Many of you probably in the audience know about 1031s and have heard chatter about what's going to happen to 1031s, but it's a major tax advantage in any real estate investment. And if you would, could you kind of cover it from a high level, and also some of the challenges that the 1031 exemption may be faced with the what's in the American Families Plan?
Sure. So I'll try to keep this at a high level. I had to promise everybody I wouldn't go on and on about the intricacies of the 1031 exemption. I'm told people don't find that as interesting as I do. I'm
just
not
CPAs.
Sure. Not sure I believe that, but that's what I'm told. Anyway, so as a general rule, when as Ron said, when you sell real estate, there's going to be a tax consequence to that sale. There's going to be a federal capital gains tax, which is upwards of 20% in today's market. There are some proposals that would potentially increase that, pretty significantly, but federal capital gains taxes, there's going to be state taxes depending on where you're at, where the property's at, and then a lot of that depreciation that Ron was talking about, which is one of the real advantages to real estate investment, does have to get recaptured in some cases on sale. And so there can be a very significant tax impact to selling real estate, particularly if you've held real estate for a long time, have been able to reduce basis, in a pretty significant way. It can be pretty prohibitive to a sale transaction, if you have to pay all those taxes. And so the 1031 exemption was put in place, actually 100 years ago this year, was put in place as a mechanism to allow people to sell real estate without having to pay taxes on the unrecognized gain on the sale. And then secondly, to kind of encourage additional investment and encourage additional development and additional real estate investment. Really high level, the 1031 exemption allows you to sell investment real estate and replace that investment real estate with a new property without having to pay taxes on the original sale. It's important to note that it's not an avoidance of tax, it's a deferral of tax, and so the 1031 exchanges is a deferral, and so it defers tax. If you buy a replacement property, the capital gain tax on the relinquished property will be deferred as long as you continue to own the replacement property, or you can continue to roll properties going forward. And so what we've seen, a lot of people's strategy would be, as they're feel like it's time to sell a property, they'll continue to do that in order to defer that tax forever. One of the real advantages of the 1031 is there's not like a date out there where all of a sudden that tax becomes due. You can continue to defer it for a long term. The one thing about 1031s, and I promise I won't get in too much detail about this, the regulations and the rules around it are very strict. And so there's a lot of different tax laws out there, different rules out there that, if you miss a date, there's a grace period, or if you do one little thing wrong, you can fix it this way or that way. Under the 1031 rules, it's very strict, and you have to comply with all of the rules in order for it to work. A couple of the main rules that just to point out, one is it is a like-kind exchange. And what like-kind exchange means is you have to exchange investment real estate for investment real estate. And where that becomes important is if you own real estate in a partnership. So if you're a member of an LLC or a partnership that owns the real estate, only the partnership itself is the holder of the real estate, and only the partnership itself can do the 1031 exchange. So if you have two partners in a partnership, one of them wants to exchange, the other one doesn't, you're really not allowed to do that under the existing 1031 rules. We have some strategies that we've helped people break up those partnerships. It's something we do quite a bit. We'll help people figure out ways to get the real estate out of the partnership into the hands of the people who want to do the exchange. But it takes some pre-planning, and it can be a bit complicated, and it's something that, it's important if that's something people want to do, that you kind of start that planning process as early as possible. When I say investment property, basically what that means is you can't sell an apartment building and go buy a single family house that you're going to live in. It's got to be investment property for investment property. So if you're going to buy vacation homes, that kind of thing, they have to be primarily used for rental or for investment purpose before it'll count. Probably the biggest issue that we run into in trying to help people complete 1031s is the timing requirements. Very strict timing requirements around 1031s. You have to identify a replacement property within 45 days after you sell your relinquished property. And then you have to close the transaction 180 days. And as Ron said, 45 days is amazingly fast, especially in today's market. It's you heard the first panel talking about, how heated the multifamily market is and how many people are chasing deals right now. And finding deals does take some time. And so one of the things that Metonic does a lot of is we help our investors and our clients try to find replacement properties, try to structure 1031 deals, but becomes really impossible if they call one day and say, hey, I sold a property last week, I've got 30 days to find a replacement property, can you help me do that? It just doesn't work.
What you want to do is to get your offer, delay that closing as long as possible, be looking aggressively for a replacement. And we've had ones recently where they just couldn't find a replacement all the time. Yeah.
And that is always a risk. And so what we tell people is, if you're even have an inclination that you might decide you want to sell your property someday in the future, call us and we'll help you do that. We'll help you make sure you're complying with all the regulations. We'll make sure that we're getting all the timing right and that we're able to really look for that replacement property. Because the last thing you want to do is make an investment in a deal that you wouldn't normally invest in just because you're trying to avoid the tax. You want to make sure that it's good real estate that you're buying, regardless of whether it's a 1031.
So that's an exceptionally good point. We see the tax tail wag the dog too many times, and if you go out and make a bad deal, the taxes aren't going to save you in the process. I think Adam's been a little bit humble in his technical expertise. He's helped me. I sold an office building, and it was just $250,000, and he helped me roll it into a large deal with another partner, but I didn't any idea that I could get that accomplished. As a CPA, I know it's extremely technical, that you dot every I and cross every T, and he's very good at those 1031s. Yeah.
Yeah, and it's I've been tracking very closely, but Josh mentioned the American Families Plan. That there was a proposal that was made to pretty significantly restrict the 1031 exchange. The American Families Plan basically had a recommendation in there that the 1031 exchange be limited to $500,000 per year per taxpayer, which is almost an elimination of the 1031 exchange as far as our world goes. That same proposal also proposed an increase in the capital gains rates from 20% to, or the maximum capital gains from 20% to almost 40%, which is basically ordinary income rates. And then also had a proposal to eliminate the step-up basis, which would probably have as big of an impact on the real estate markets as anything we've seen.
It's huge.
Yeah. And the House Ways and Means Committee put their recommendation in recently that did not include the elimination of the step-up basis, did not include the 1031 exemption repeal, but we do think that there's some risk in that because it's not, I think the White House is going to continue to pursue, particularly the 1031, the 1031 repeal. I think what you'll see if that happens, there's a couple of different things that could happen there. If they increase the capital gains rates, they eliminate the 1031 exemption, but they keep the step-up basis in place, it's going to just kill deal flow. Because I can't think of a good reason why anybody would sell any kind of an income-producing property if that were the case. I don't think that's going to happen. I think they're going to be cognizant of that. If the 1031 exemption does stay in place and they eliminate the step-up basis, I think that could actually increase a little bit of deal flow, because with the elimination of the step-up basis, what that would mean is anybody who is receiving real estate through an estate is going to have to pay on all of the unrecognized gain at the time of the transfer. And so unless that property has some ability to be financed or have some other liquidity event, they're not going to be able to pay that tax. And so it could possibly force a little bit of product onto the market.
Yeah. One thing I've learned of tax law changes, I remember back in grad school studying under Reagan, and it's not over till it's over, until the very end, and it will change substantially. But the White House is after making people pay more, and capital gains is on the chopping block. We'll probably see some increase in capital gains. We'll probably see some tax rate increases. I just hope they're more modest amount. One hopeful sign I would say is that on the Democrat side, they're kind of fighting with each other. You got the progressives and you got the more conservative ones. And as they fight on the size of that bill, it's $3.5 trillion, if they can, which is a lot of money, by the way. But as they start bringing that down to maybe $1.5, $2 trillion, they need less revenue. And when they need less revenue, they don't have to go searching for these deals. And the real estate industry is a very powerful lobbyist. And so I'm hopeful the 1031 stays in place. I understand the logic of the step up in bases. I don't want it to get rid of because it's part of my plan and it cures everything. So when somebody dies, the kids take over. You just got to go find the current value because you may not know the basis of things. So it makes it a lot easier. But I understand the logic. Nobody's paid tax on it and somebody should pay tax on it. Just because you're giving it to the next generation doesn't mean it should be exempt. But they're really after the large guys that can grow their portfolios, never pay taxes, they don't sell things, pull cash off of it. They just think that you're not paying your fair shares, the buzzwords right now. So whether side you agree with, we're hoping to change it a little bit less modest, but I've seen more hope lately that we won't get all those through at once. Yeah. But they're coming after it pretty hard. Yeah.
Yeah, and to the extent you do have properties that you're kind of thinking about selling and are thinking about 1031s, probably a pretty good time to kind of really start thinking about that, just because there has been some talk about some of this being retroactive, but I'm not exactly sure how that would work. So I think there probably is still some opportunity, to be able to do that here in the near future before anything really, gets finalized.
So if people haven't invested in private real estate, one thing you should realize is that 30% of all the wealth in the United States is in privately held real estate. So if you're not in it, you got to say, what do those guys know that I don't know? And it's a wonderful mechanism for growing your long-term wealth. It holds its intrinsic value, it produces cash flow, and it's a limited supply, so it's been going up a lot lately.
I'm telling you, I think Ron can do my job for me. I think he just did. But,
I'm a believer.